Hi, I'm Dr. Ron Cheek, and welcome to my presentation on pro formas. I'm an entrepreneurship professor and have a background in mortgage banking, real estate developing, venture capitalist in several industries, and at my core, a serial entrepreneur. The purpose of this podcast is to provide a background in pro formas for startup or early stage companies. For those listeners with a background in accounting or finance, the pro formas we will be discussing are general projected income statements and do not follow any standard GAAP or other financial guidelines. These pro formas are primarily aimed at tools for small startup companies. One, they can be used as management tools to predict future revenue streams. Two, projections that can be used either to raise capital or perhaps borrow from lenders. And three, finally, a measurement instrument to determine performance. This is done by comparing projected revenues and expenses to actual performances. Wikipedia explains that for business, pro formas model the anticipated financial results of a business over a period of time. Pro formas have a particular focus on cash flows, the lifeblood of any new or startup organization. The time parameters of the pro forma are: one, the first year is done on a month-by-month basis. Then a summary is provided for years 1 through 3. The figures for pro formas are derived from: one, the owner's knowledge and expertise of the industry that they're proposing the organization in; two, research on competitors in this same industry; and three, research on the industry as a whole. Is this industry growing? Is it declining? Or is it staying flat? There are several primary components to all pro formas. One are revenues. This is broken down into units and in sales dollars. Two, cost. Cost has two components: variable costs that are based on the number of units sold, and fixed costs that occur regardless of the number of units sold. For example, rent, utilities, phone, internet service, management and sports staff salaries, all these will occur regardless of the number of units sold. Every entrepreneur seeks to make as many expenses as possible variable costs. In this manner, if no sales occurs, there will be limited resources spent on expenses. For your information, I've developed a sample pro forma. This pro forma is for a new organization called Joe's Seafood Restaurant. Joe has been an executive chef for over 15 years and has decided to set up his own restaurant. Joe has extensive knowledge in all areas of the restaurant industry and feels his unique type of seafood restaurant will be successful. Unfortunately, Joe has not accumulated any resources. In order to start his business, he must find investors to fund all of his capital requirements. This includes his one-time setup costs and the losses he will incur until he becomes profitable. In this pro forma, you can see that Joe has not projected any revenues for the first 90 days. He realizes that it will take 90 days to negotiate a lease, get the equipment that is required, and then finally get the necessary permits, complete renovations of the space, and finally open the doors. This 90-day period is realistic for most new companies. We begin the discussion of the pro forma by examining revenue. When we think of revenue streams in a restaurant, it can include any number of sources. However, what I have done here, just as I strongly encourage anyone to do with a new company, I've identified the two major categories of revenue. As the business matures, the pro forma can be expanded, but early on in the process, it is best to keep it simple. It is absolutely necessary for the owner to understand revenues in terms of units and dollars. Joe has chosen his two major categories as food and beverages. In the units sold, Joe has estimated that in the fourth month, when he opens, he will sell 100 meals per day and will be open 30 days per month. This means that in the fourth month, he will sell 3,000 meals. In the fifth month, his second month of sale, he expects to increase the sales of meals to 3,450. He can be expected to increase those each month. Using his total units for year one, he can project sales of units for years 2 and 3. As these estimates get further and further out, Joe and potential investors understand and recognize they're only estimates, and there is no need to project them on a month-by-month basis. Joe's second category of revenue is beverages. Joe has a sports bar inside the restaurant where patrons are able to go prior or after dinner. Joe projects for every meal he serves, he will sell 3 beverages. Joe has projected his sales as $15 as the average revenue from food and $1.50 for the average beverage sale. In order to get his revenues for food in month 4, Joe multiplies the number of units sold. If we look in E9, Joe shows 3,000 units sold. If we go to E12, this figure represents E9 times $15 for a total of $45,000 in sales of food. If we go to E13, this figure represents E10, 9,000 times $1.50 is $13,500 in revenue from beverages. The total revenue for the month, when we combine beverages and food, is $58,500 would be the total revenue for the month. Now we have to look at Joe's cost in terms of variable and fixed costs. Remember that variable costs only occur when sales are made. Fixed costs occur irrespective of sales. Remember, the entrepreneur's goal is to minimize the fixed costs. Let's first look at variable costs. In Joe's assumption sheet, he explains to potential investors that his variable cost for food is 60% of revenue, including labor, and his cost for beverages is 40% of revenues, including labor. Next, we look at the fixed costs. Remember, we discussed that Joe has estimated that it will take 90 days to open the doors to his new restaurant. Since it will require his full-time attention to get this done, he's left his old employer. Joe does not have any money and must draw a salary. Investors expect to pay for work being done in the business. If Joe does not pay himself a salary, it will concern and actually may turn some investors off. Investors expect to pay for work that is done. So even though there are no sales, many of the fixed costs are incurred. Notice that as the opening date gets close, in month 3, salaries go from $5,000 to $7,500. Joe has brought in an assistant manager. The assistant manager really won't be necessary during the planning stages, but as the grand opening gets closer, Joe needs help. Joe has the expertise and makes this decision. Additional personnel will vary based on the type of organization being built. One-time setup costs. When Joe opens up his restaurant, there'll be some one-time setup costs. It can be as simple as rental and utility deposits to machinery and equipment or furniture and fixtures. Since Joe does not have any funds of his own, it's important that he carefully research, understands, and includes all the funds that he needs. Now we move to the minimum cash requirements. When we look in B39, we see the minimum cash requirements is $68,800. This is the total amount of money Joe will need from an investor in order to open his restaurant. To an investor looking at Joe's pro forma, they can clearly see his needs as follows. 1, in the first month, Joe will require $8,800 for fixed costs, $60,000 for one-time setup costs, for a total of $68,800. For the second month, since there still are not any revenues, he'll need an additional $8,800 to cover the second month's fixed costs. This brings his total required after 2 months to $77,600. In the third month, since he added an assistant manager, fixed cost increases to $11,300. When added to the $77,600 from month 2, it becomes a total of $88,900 after the third month. In the fourth month, Joe opens a restaurant and has net operating income of $12,100. He has reached break-even and will not require any additional funds. From the investor standpoint, if Joe asks for $88,900, that would be a reasonable amount. If Joe asked for $90,000, investor would still feel comfortable based on this pro forma. However, if Joe came in and asked for $150,000, it would cause concerns for investors. So somewhere around $88,900 would be the amount that Joe would be looking for from investors. This is a simplified pro forma. By using this approach, you can fill in the numbers to develop a pro forma for your new company and see if it makes financial sense. The development of a pro forma is known as running the numbers. Before putting money into a startup or a company of any sort, you should do these financial projections and come up with sound decisions whether to do the business. The performer helps the entrepreneur in his or her go or no go decision. It is invaluable in the decision-making process. Understanding performers will also help in your future endeavors, as you will invariably be requested to invest in some relatively new or startup organization. I hope this podcast helps in your understanding of performance. Good luck in your future endeavors. Thanks again for taking the time to listen to my podcast on performance. I look forward to your comments, questions, and suggestions. This is Dr. Ron Cheek. Thank you.